How's it going? My name is Jonathan Zaragoza, and this is my presentation on private placement offerings, due diligence, and term sheets. On this first slide, we're going to talk a bit about what private placement offerings are and how they differ from your traditional forms of raising capital. As we know, most companies typically raise invested capital through initial public offerings. Alternative to IPOs, private placements allow firms to raise capitals through private funding as opposed to public funding. These opportunities are only available to select investors, which typically include accredited investors, which are people who typically make over $100,000 a year or have a combined net worth with their spouse over $1 million. We include major banks, mutual funds, insurance firms, and pension funds as well. And as we know, these are privately traded securities, so they are not available in the open market. And in comparison to publicly traded securities, there is minimal regulation with private placement offerings. With PPOs, they are not held to the same disclosure and reporting requirements as with publicly traded securities. And under the Securities Act of 1933, the Section 5 registry is not required, thus saving time and money for both the investor and the firm in comparison to other forms of raising invested capital. On this slide here, we're going to talk a bit about what term sheets are, what's included in the term sheet, and how they differ from private placement memorandums. What the term sheet is, it's a non-binding agreement between parties. Within this document, we'll outline the basic terms and conditions under which the investment will be made. Typically included in here will include the involved parties, so who's involved in the transaction, the exchange terms, so who's getting how much equity in exchange for how much invested capital. We'll talk a bit about the voting rights, as well as the structure of the board of directors. With the term sheet, it's a great financial instrument because it allows involved parties to discuss their differences before a formal legally binding contract is formed, otherwise known as a private placement memorandum. Lastly, we have our slide on due diligence. Basically, what due diligence is the process of reviewing all the information that we have available to us regarding a business venture. Typically, what we'll do during this process, we'll verify that all the information on the financial statement is accurate and in no shape or form it was misrepresented in any way. During this process, we'll also do our own valuation of the firm so that we get a more honest opinion on the actual valuation of the firm down the line. Another thing we want to take a look at is future projections. We want to make sure that these projections are not over exaggerated in any shape or form based on their future earnings. And lastly, we want to verify all contracts, the longevity of them, who they're set up with, and make sure they are all valid contracts. So today we talked a bit about what private placement offerings are, how they differ from your traditional forms of raising invested capital. We talked a bit about what term sheets are, what's included in them, and how they differ from private placement memorandums. And lastly, we talked about due diligence and what we typically do during the due diligence process. Essentially, due diligence is the